Hello, everyone. Happy Monday. Hope everybody had a great weekend. I'm uh, recording this on Sunday, so it's really gorgeous outside. And I hope you all got a chance to enjoy it. Today will be equally enjoyable, at least interesting. Today we're going to talk about budgeting, and we're going to do this thing called a master budget. It starts out complex, but believe me, it's just a bunch of little tiny simple parts that we bring it all together. And then we're going to bring together this concept of budgeting with some of the things that we talked about so far. We're going to talk about different types of analysis and stuff. So we're really getting into the more fortune telling aspect of accounting. This is what you guys signed up for. Okay. This is where we are setting a budget. We are determining what will happen if we change different things. Okay. Um, so that said, we're in week 4. So now is the time to start checking what assignments are missing and making sure that you guys are getting those in, okay? Because there's only 2 more weeks to get all of your coursework in and graded and move on from my course on to the rest of your career and so on, okay? Also, check under modules. In addition to this lecture, there's another video for you guys to watch that's about master budgeting. It might, make things clearer than I do. At any rate, it's another resource for you guys to use. Okay, with that said, I'm going to go ahead and share my screen, and we will get on with the presentation part. Okay, so first up, we're going to talk about this concept of a master budget, okay, that draws everything together. All right, now budget is one of those words that we use every day, but we might not necessarily know the definition, especially as it relates to accounting. So just to make sure that we're all on the same page, a budget is a detailed quantitative plan for acquiring and using financial and other resources over a specified forthcoming time. So we're looking into the future, covering a specific period. Okay, a company's budget ordinarily covers a 1-year period corresponding to its fiscal year. Okay. Some companies will also use a perpetual budget. It's a 12-month budget that just keeps rolling forward each year. Okay, so here is an example of an operating budget. It covers a 1-year period and it corresponds to the fiscal year. All right, it can be divided into quarters, and we'll be looking at that quarterly budget in this chapter, but it can be expanded to include the entire year. Okay. Nope, wait, I went forward too quickly. In the case of a continuous budget, it's a 12-month budget, but it rolls forward 1 month or quarter as the current month or quarter is completed. So it keeps pushing out and out and out by a year. Okay. All right. So when we make this budget, we need it for 2 different things. Okay. Remember, this is an accounting cycle. Okay. So we're going to use this budget to plan. All right. We're going to, develop our objectives and decide how we're going to control our costs. Then we're going to let the year go by, and then we're going to compare our budget to how we actually did as a means of control. Okay, so that we can see how closely we kept to our budget and act accordingly. Okay, in order to be effective, your budget has to do both. Okay, so here are the benefits of creating a budget? I mean, they're pretty self-explanatory. We wouldn't want to just run a business flying by the seat of our pants, right? Let's just throw some money in the air and wherever it lands, that's what we're going to do with it. Okay. But specifically, we make our budget to define our goals, to think about and plan the future as a means of allocating our resources. Remember, we talked about those bottlenecks last week, okay? We don't have infinite resources, and so we need to figure out, how we're going to face those shortfalls, okay? Again, it uncovers potential bottlenecks. It coordinates our activities and communicates our plans to the whole business, okay? So, from a control standpoint, all right, organizations compare their budgets to the actual results, as I said on a previous slide. That's going to improve our efficiency and effectiveness, okay? And we should reward our employees when they fall within budget. All right, so before we get into the actual nuts and bolts of this budget, okay, there are kind of two ways that we can work on developing it, okay? We can either um, do a top-down budget or a self-imposed budget. And to be entirely honest, this is a spectrum, okay? And most companies fall somewhere in the middle, all right? So in a self-imposed budget or a participative budget, this is where all of your mid-level managers actually participate in developing this budget. Unlike the top-down version, which is where my way or the highway, upper management says this is what we're doing, and no ifs, ands, or buts about it. Okay, so again, your supervisors are feeding data up to middle management, who is providing information to top management, and together they're working collaboratively to come up with this budget. Okay, the upside of this is that you are valuing your employees and their opinions. Okay. The frontline managers have that day-to-day interaction with the customers. Okay. They might have more accurate data than your CEO has, right? When you take their opinion into account, it makes them feel empowered and take ownership for this budget. Okay. And that's a big motivator. Okay. It also, once you have that ownership, you get buy-in. I mean, your frontline managers are more likely to follow a budget that they had some say in. Okay. But you should review these budgets, okay? Don't just throw it to your frontline managers and say, okay, you write me a budget and I'll go with whatever you say. Okay, there should be some form of review to prevent budget slack. Okay, I think any of us who have been associated with any kind of government contract or civil service, we're all familiar with that concept. We have to spend all the money they gave us by the year end, or next year they'll give us less money, right? That's budget slack. We're trying to get more funds, okay, so that we can, we don't have to be as tight on our budget as maybe we should be, okay? All right, so this is what a master budget looks like. All right, it looks really complex in this picture, okay? But we're going to break it down into each piece, and we're going to see how those pieces all flow into one another to create our master budget, okay? Okay, there are 10 different schedules, all right? And they're designed to answer these 10 questions, okay? How much sales revenue will we earn? How much cash are we going to collect? Okay, how much raw material will we need to purchase? How much manufacturing costs will we incur? How much cash will we pay to our suppliers? And so on and so forth, okay? All right. So, because our crystal ball only works so well, all right, we are projecting into the future, okay? So we are basing this budget on some estimates and also some assumptions, okay? So for example, when we're looking at our sales budget, it requires the following three assumptions, okay? Um, what are the budgeted unit sales? What is the budgeted selling price per unit? And what percentage of accounts receivable will be collected in the current and subsequent periods? We can't know for sure, but we're going to give it our best estimate, okay? All right, and we'll be using Excel because why wouldn't we? All right, so our first budget, spoiler from the last slide, is going to be our sales budget. All right, so here's the data we have to work with. The Royal Company is preparing budgets for the quarter ending June 30th. Budgeted sales for the next 5 months are as follows. You can see here on the slide, and the selling price is $10 per unit. Okay, so this is our quarterly sales schedule, okay, as part of our master budget. So we have our sales in units. We got that from this previous slide right here. This is an estimate. Based on prior years, we've estimated this is what our sales are going to be. Each unit is sold for $10. So we take our budgeted sales times our unit price to get our total budgeted sales in dollars. And then all the way on the right-hand side, we're just adding up each of these rows, okay, to be our whole quarter amount. Pretty easy so far, right? That's all we have to do. That's the entire sales schedule. Now, that is going to flow into our cash collection schedule. Okay, so this is the information that we need for that. All right, so we're making our sales on account, all of them. All right, we collect 70% in the month of sale, and 30% is collected in the month following. Okay, so the March 31st accounts receivable balance of $30,000 will be collected in full on April. So in the last quarter, we had some collections outstanding. So we are going to collect those in this quarter. Okay. So accounts receivable left over in April is 30,000. All right. So April sales, we sold $200,000 worth of stuff in April. That came from our sales budget, okay, for the prior quarter. All right, 70,000 of that we collected back in April. The other 30,000 is still hanging out for us to collect, okay? All right, so in May, we sell $500,000 worth of product. Also came from our sales budget for this quarter. All right. Oh, I'm sorry. April is this quarter too. I was just talking crazy talk. Sorry. April, $200,000. We collect 70% in the month of April. Okay, so disregard what I said a minute ago. In April, we collect $140,000. 30% we collect in May. So the 60,000 flows over. So May's sales, $500,000. We collect 70,000 of that in May. 350,000. Okay, the other 30,000 flows over until June. Okay. All right. Then in June, we sell $300,000 worth, but we only collect that 30,000. Okay. The 300,000. That's 70%. The 30% is going to flow over into the next quarter. Okay. So then we just add all of these numbers up to get our total collections for the quarter. Next is our production budget. Okay. So We just completed our sales budget and our expected cash collections. That's going to flow into our production budget because now we need to know how much we have to make to fulfill these sales that we expect to make. All right. So this is the information you need to know. The management at Royal Company wants ending inventory to be equal to 20% of the following month's budgeted sales in units. On March 31st, 4,000 units were on hand. Let's prepare the production budget. That means when you start the month, okay, you want to have 20% of what you need, okay? So we have our budgeted sales in units, okay? Now we have our desired ending inventory. Okay. So we need to start each month with 20% already. The first day of May, we need 20% of May's inventory already on hand. Okay. So that's 50,000 times 20%, 10,000. Okay. So we add the amount that we expect to sell in April plus this extra 20% of next month's. That's how much inventory we need for in the month of April, 30,000. But we started the month of April with 4,000 units from the last month. 20% we already have. Okay, so we only have to produce 26,000 units. Okay, so same thing for May. Okay, we budgeted sales of 50,000 units. We want our ending inventory to be 6,000 units. So we're started for June, right? Okay. So in May, we're going to need to have a total of 56,000 units of our product, but we already had 10,000 from the month before, right? Because we made that little extra to start the month off right. Okay, 10,000. So we really only need to produce 46,000 units. And so on. Do the same thing in June, and then you add up your totals to get your quarterly totals. Okay. Just remember that you're going to carry forward an extra 20%. Okay. All right. Now, in order to have this inventory that we're going to produce ourselves, we're making it ourselves. Okay. So now we have to figure out how much we need in materials in order to make all this inventory we need each month. So at Royal Company, 5 pounds of material are required per unit of product. Management wants materials on hand at the end of each month equal to 10% of the following month's production. So this sounds kind of like our inventory, right? We need to start the month with a little bit already. Okay, in this case, that little bit is going to be 10%. On March 31st, 13,000 pounds of material are on hand. Material cost is 40 cents per pound. All right, let's look at direct materials. Again, our production. This is from our sales budget. Okay, how many units of each item we actually need, right? Materials per unit, we need 5 pounds of raw material to make each unit. So 26,000 units times 5 pounds equals, let's see, let me pause this real quick. Sorry about that. Like I said, my client phone is always on. So that was it going off in the background. Sorry about that. Okay. So again, we have our production levels. These came from our sales budget. Okay, this is how much we have to produce to meet our projected sales for each month. We need 5 pounds of raw material in order to create this inventory that we need. Okay, so then we need um our ending inventory for the next month. Remember, we need 10% of the following month's production needs. So we need 10% of the raw materials that we're going to need so we can start production on the first day of May. Okay, so that gives us our total need. But remember, we started off with a little bit of raw material from last month. Okay, so we have this 13,000. So we can subtract that from our total need, which gives us our materials to be purchased of 140,000 pounds. Okay? All right. So same thing for the following month. We need 46,000 units, 5 pounds per unit. That gives us total need of 230,000. All right, then we need 10% of next month's. So on the first day of June, we can just start producing, right? So that gives us our total need. All right, minus this beginning inventory. So we started off with this 23,000 pounds of material from the last month. Okay, and that gives us, we're going to subtract that here because we don't need to make this amount. We already had it on hand. So that gives us 221,500. Okay. Sorry about that. I just noticed that my screen sharing is paused. Let's fix that real quick because I'm sure you're wondering why you weren't seeing those slides. Here we go. Okay, so as I said, this 23,000 flows forward and fills in here. June is going to be the same thing, and we're going to add all these up for the quarter. Okay, now, um, okay, now, how much are we going to pay for these materials that we need to do our production? Well, we usually pay 40 cents per pound for our materials, right? So half of the month's purchases is paid for in the month of purchase, and the other half is paid in the following month. So the March 31st accounts payable balance is 12,000. So this is how much we're paying, okay? So we're going to start in April with 12,000 hanging out from the previous month. We need to purchase $56,000 worth of materials. That comes from our last schedule. We know how many pounds of material, 40 cents per pound we're paying, right? And we're going to pay for half of it in this month. That's here. And the other half is going to flow over to the next month. All right. So then May, okay, we have that 28,000. We need to purchase 88,600, okay, but we're only paying for half of it now. We're going to pay for the other half in the following month. Okay, same thing for June. We're only paying for half. The other half is going to flow over into the next quarter. All right, so we also need labor to produce this inventory. So each unit of product requires 0.05 hours, that's 3 minutes of direct labor. The labor is going to be unskilled because apparently this is a really easy process. Okay, so Royal pays its workers at the rate of $10 per hour. So let's do this budget. All right, we know our units that we need. Okay, we've been using this for the last few schedules. We're going to multiply that times 3 minutes per unit, okay, to have our number of hours. Then we're just going to multiply that by 10 because $10 an hour, and that's going to give us our direct labor cost for each month. Easy peasy. Okay, so how are we going to distribute our overhead? So at Royal Manufacturing, overhead is applied to units of production on the basis of direct labor hours. Lucky for us, we just got finished calculating our direct labor hours. The variable manufacturing overhead rate is $20 per direct labor hour, and we have some fixed manufacturing overhead. It's $50,000 per month, which includes $20,000 of non-cash costs. That's depreciation. Okay? So we have our budgeted hours from our last schedule. We're going to multiply those by $20 per hour. That's our variable overhead rate. Then we're going to add that 50,000 of fixed manufacturing overhead. All right. Then we're going to subtract out the non-cash costs because that's not money out of our pocket, so we don't have to budget for that. Okay, and that's going to give us our cash disbursement for manufacturing overhead. This one's also pretty simple. Okay, there's no overflow stepwise to other months or anything like that. Okay, so let's look at our ending finished goods inventory. Okay, budget. So now that we know direct materials, direct labor, we can figure out how much our cost of goods sold will be. Okay. So each unit takes 5 pounds of material at 40 cents. That's $2. Direct labor of 3 minutes at $10 an hour. Our manufacturing overhead per unit. So we have a total of close to $5 per unit. Okay. Then our ending inventory in units, 5,000. Our unit production cost of $4.99 gives us our ending finished goods inventory. Okay. Now let's look at our selling and administrative expenses. So we have variable selling and administrative expenses. Okay. That's 50 cents per unit. And then we're going to have a fixed cost of about 70,000 per month. Okay. But then there's this 10,000 that's not a cash outflow. Okay. That's depreciation. So we'll subtract that out when we get to the budget. All right. So our budgeted sales from our sales budget, we have to pay our salespeople 50 cents per sale. That gives us variable expenses of 10,000. So a total variable expense of 10,000, right? We add our fixed expense of 70,000. That gives us 80,000. And then we subtract out this depreciation because that's not cash. Okay. So that brings us back down to 70,000. Okay. And then we're going to do the same thing for all of the other months. Nothing flows over in a weird way or anything like that. And then we're going to add all these expenses. So we have the quarterly rate here. Okay. So what about cash? Okay. The cash budget has 4 sections, kind of like a statement of cash flows. Okay, your cash receipts section, that's all our cash inflows, all right, except cash received from financing. We have cash disbursements. It is what it says it is. That's our cash payments. And then we have our cash excess or deficiency section. And that'll tell us if we need to borrow money for the month. And then our financing section details what borrowings we've made previously and how we're going to pay them back. Okay, so here is our information to make this budget. All right. So Royal maintains a 16% open line of credit for 75,000. They maintain a minimum cash balance of 30,000. They borrow on the first day of the month and they repay their loans on the last day of the month. They pay a cash dividend of 49,000 in April only. And then they make purchases of 143,700 of equipment in May and 48,300 in June. Both are going to be paid in cash. And then when April, the first day of our quarter, we have a cash balance of $40,000. So this is probably our most complex schedule. So we start off with $40,000. We're going to collect 170,000. Okay, so we have 210,000 available. All right. We need materials, direct labor, manufacturing overhead, and selling and administrative expenses. Remember, these came from our previous budgets. All right. We also have this dividend that we paid of 49,000. Okay. So total disbursement of $228,000. All right. But we only had 210,000, right? So we have a deficiency of 18,000. All right. So because we have to start next month with 30,000, we're going to borrow this 18,000 plus an additional 30,000. Okay. So we have enough money to make it to the next month. So the total amount we have to borrow is 48,000 to get us through the month. All right. So when we start May, we have 30,000 that we need. Okay. We collect 410,000. So our cash available is 440,000. Here are our manufacturing expenses and then our selling expenses. Here's our equipment purchase for 143,000. Remember that? Okay, so total cash, we need $400,000 and then we need 40,000 for next month. But look, we've already got it here, so we don't have to do anything. We don't need to borrow money or anything else. Okay. Okay. And then you just carry this along, totals for the quarter. Okay. So now your cash budget is complete and you can use this to make your income statement. All right. So this is your budgeted income statement that we've been using so far, and we've been wondering where all these numbers come from that we're moving around to make predictions using this income statement. Now we know the sales come from the sales budget, the ending finished goods for cost of goods sold, that comes from that schedule. Our selling and administrative expenses, that comes from our S&A expense budget. And then our cash budget is going to show us this interest expense. Okay. All right. Same thing with the balance sheet. All right. When we started out, we've got this land of 50,000, common stock 150, retained earnings of 248,650 as of April 1st, and equipment of $175,000. All right. Accounts receivable. Remember, that's this 30% of June sales that we're going to collect in the next month. Okay, raw materials inventory. That's the rollover that we've got. Okay, finished goods inventory. That's what we needed to end with, right? Our land, they told us on the last slide, equipment, total assets. Our accounts payable, remember, we paid 50% in the month of June, but we carried over to the next quarter. All right. Then our common stock and our retained earnings from the previous slide. Okay. That is it for our master budget. Again, there is another video for you guys in the module that covers the same material, might be a little clearer for you. It's, if please, avail yourself of that.